Good morning, friends. Today we will discuss Unit 8 of Financial Management. The subject is Financial Markets. Before discussing financial market, let me first tell you what are the objectives of our study today. First, we will discuss the significance of financial market. Then we will discuss the role of financial markets. Next, we will discuss the different participants of financial markets. Next, we will discuss the features, purpose of financial market. What will be our structure of discussion? In today's class, first I will give a introduction to financial market. Then we will discuss role and functions of financial market. Next, we will discuss different types of financial market, in which we will discuss money market, capital market, equity market, debt market, derivative market, commodity market, foreign exchange market or forex market, and other different type of market. Next, we will discuss different participants in financial market. What are the participants? We will discuss the participants in money market and participants in capital market. Next, we will summarize our discussion. We will discuss some keywords and we will discuss some questions. This will be our scheme of discussion today. Let me first tell you what is a market. Traditionally, market is defined as a place where buyer and sellers meet together to exchange goods, service, financial product or instruments. Traditional market is defined to a place. On the basis of this, market can be divided into three parts. One is product market, another is factor market, another is financial market. What is a product market? Product market is a market where different goods and services are traded. What is a factor market? In a factor market, different factors of productions are traded. We know in economics, there are four factors of production: land, labor, capital, organization, out of which land, labor, and capital are traded in factor market. When factor market, for land, rent is determined. In factor market, for labor, wages is determined. In factor market, for capital, interest rate is determined. Then it comes to financial market. What is financial market? Financial market is a market where different financial claims are traded. Financial claims means different type of financial securities are traded in financial market. Next, we will discuss what is the role and importance of financial market. What role financial market plays in an economy? In order to understand this, let me first draw your attention to a diagram. Now please see, in this diagram, there are two parties. First one is, in an economy, there are some people who have surplus money. What is surplus money? their income is more than their expenditure. So they have some surplus money and they want to lend this money to someone. They are the ultimate lenders in the market. They have surplus money. Now they want to give it to somebody, someone else who wants this money. Those are known as borrowers or ultimate borrowers. Who are ultimate borrowers? Ultimate borrowers are those persons who want to spend or invest more than their income. They are ultimate borrowers. So in an economy, there are two parties. One is ultimate lender, another is ultimate borrower. Ultimate lender has surplus money, ultimate borrowers has deficit money. Ultimate lenders want to give this money and ultimate borrowers wants to take this money. Now, there are two methods of meeting these lenders and borrowers. What are the two methods of meeting these lenders and borrowers? One is they can meet together with the help of a financial intermediary. Who is a financial intermediary? Financial intermediary is a person who is intermediate between ultimate lender and ultimate borrowers. They take the money from lenders and give it to borrowers. They may be in form of financial institutions. They may be in form of banks, insurance companies, developmental financial institutions. They may be different. They are financial intermediaries. And this process of financing is known as indirect finance. What is indirect finance? Indirect finance is a concept where ultimate lender and ultimate borrower meet together with the help of some financial intermediaries. They meet together with the help of some financial institutions. And this entire process is known as financial intermediation. This is known as financial intermediation, or this is known as indirect finance. But in case of indirect finance, the margin financial intermediary give lower rate of interest to lenders and borrow and give it to the borrowers at a higher rate of interest. Let's take an example. They will take 8%. They will give 8% on deposit given by ultimate lenders. And they will spend this money, they will give this money to the borrowers at 14%. The 6% margin is enjoyed by financial intermediary. Now there is a concept that why 6% will be enjoyed by financial intermediary. The lenders and borrowers decide to meet together each other without financial intermediary, and that can be possible with the help of financial market. And this process is known as direct finance. So in case of financial market, what happens? The person who wants to borrow money, they will issue some securities in financial market, and the lenders will buy these securities from the financial market, and ultimately the lenders and borrowers will exchange the resources between themselves without financial institution. This process is known as financial disintermediation. Financial disintermediation, and this is a case of direct finance. So we have discussed indirect finance and we have discussed direct finance. In case of indirect finance, ultimate lenders and ultimate borrowers meet together with the help of financial institutions. But in case of indirect finance, ultimate lender and borrowers meet together directly without any financial intermediary. They meet together with the help of financial markets. Borrowers issue securities and lenders buy this security, and in this process money is channelized from lenders to borrowers, and this concept is known as direct finance. Next we will discuss what are the functions of a financial market. We have discussed financial market helps to channelize resources. They helps to channelize resources from lenders to borrowers. And what are the functions of financial market? The functions of financial market can be classified into three parts. First one, economic function. Next one, financial function. Next one, other function. There are three important functions of financial market. First, economic function. We have already discussed what are the economic function. It helps to channelize resources from seller, from saver to seekers, from ultimate savers to ultimate borrowers. Then once the funds are channelized, the borrowers give interest or dividend. That means if the savers invest in equity instruments, they will yield dividend. And if the savers invest in debt instruments, those will generate interest. So lenders and investors earn interest and dividend on their surplus money, as a result of which the income of the country increases or national income increases. This is the second important benefit of financial market. This is known as economic function of financial market. Third function of financial market is generally borrowers borrow fund for productive purposes. They take the funds from savers and use it for productive purposes. If the productive purpose means for construction of new business, for construction of land building, for construction of new plant machinery, if they invest in productive purposes, the productive assets are created and it results in generation of additional income, as a result of which the GDP of the country increases. And the financial market helps to transfer resources from the economy, from saver to seeker. It provides a channel through which saving is flow into capital of the country. That means the financial market helps in capital formation of the country. These are economic functions of financial market. Next we will discuss what are the finance function or financial function of the financial market. With the help of financial market, the borrowers find funds to carry out their plan. They have the plan to set up new building, new machinery, new business, to diversify into new business. So they have some productive plan, and for this financial market provide necessary funds. Next, it provides lenders with earning assets, and it helps the lenders to create wealth for themselves. Investors can invest in real assets of the companies with the help of financial market. When you buy share of a company, you indirectly buy the company, you own the company, you own the earning assets of the company. So ultimately it helps in wealth creation in the economy. Next, the financial market provide liquidity. What is liquidity? Liquidity means easy convertibility into cash. The financial securities which the borrower issue are mostly liquid in nature. They have a secondary market. When the investor want money, they can sell these securities in the market and generate resources. So it provides liquidity, necessary liquidity in the market. What are the other function of financial market? The other function of financial market is price discovery. What is price discovery? In financial market, different type of financial securities are bought and sold, and there is continuous buying and selling of this security. Ultimately, the real price of the share, real price of the bond is discovered through the process of trading of securities in the financial market. And financial market helps in discovering the true value, real value, intrinsic value of a security. And the financial market helps to provide liquidity. We have already discussed, in the absence of financial market, liquidity of the assets will not be possible. If an investor invests in a real asset, it is very difficult to liquidate that assets. Let's take an example. You put 5 crores in a land or building, in a real asset. But if you want to sell that asset immediately, you will not find out a buyer. But if you invest 5 crores in a stock or a bond, if you want to sell that asset, there are many buyers and you can easily liquidate your investment. Next, the financial market helps to reduce cost. What type of cost? Generally, if there is absence of financial market, there will be two type of cost. The person who has money, they will source the person who wants money. So there are two type of cost will be involved. The person who wants money, they will invest some money in searching. And how they will search? They will search through advertisement. So the search cost is reduced due to existence of financial market. And this search cost is known as explicit cost. So there is saving in explicit cost of the investor. Similarly, the time which the investor save, not by searching the person who will take that money, that saving of time has some cost that is known as implicit cost. So with the help of financial market, there will be saving of explicit cost and implicit cost of the person who has surplus money. These are the important functions of a financial market. There are two important questions. What do you mean by financial market? Give any two important functions of financial market. We have already discussed. Next, we will discuss different types of financial market. How we can categorize, classify the financial market. The financial markets can be classified into two broad categories. One is known as organized market, another is known as unorganized market. What is an organized market? An organized market is a market where there is rules, regulations, there is exchange, there is a platform. It is organized. And unorganized market, which is not organized, is known as unorganized market. Generally, the unorganized market is dominated by money lenders, indigenous bankers, sahukars. These are the person who create unorganized financial market. And in case of organized financial market, we can classify into three broad categories: capital market, money market, and other market. We will discuss one by one different type of financial markets. First, we will discuss regarding money market. Let me first tell you what is a money market. Money market is a market for short-term funds. What is short-term funds? The funds whose duration is less than 1 year. That is known as money market. So in money market, short-term funds are bought and sold. The duration of the funds may be less than 1 day to 1 year, means overnight to 1 year. That type of market is known as money market. So in the money market, the securities have a duration of less than 1 year. If a security have a duration more than 1 year, it is not traded in money market. The money market is a market for short-term money. In case of money market, the near money items are bought and sold. What is near money items? Which are close substitute of money. That means those are those securities which are highly liquid and which can be liquidated at any time. That is known as close substitute of money or near money items. So in money market, near money items or close substitute of money are bought and sold. Normally, money market is a wholesale market. It's a market where banks generally trade. Hence, we call it interbank market. So money market is a market where short-term money is bought and sold. Next, we will discuss what is the benefit of money market. Money market provides short-term funds for those people who want it. Let's take an example. One bank is there. Next day, it has to pay 250 crores to a party. And it does not have sufficient money to pay 250 crores. He will get the money, the bank will get the deposit the next day. He has to pay, let's say, bank has to pay tomorrow 250 crores and bank will get 250 crores day after tomorrow. That means the bank wants 250 crores for only one day. If the bank wants 250 crores for only one day, where he will get that money? He will get that money in money market. There are many instruments with the help of which he can raise 250 crores for one day. Those are known as call money. There are call money, there are notice money, there are treasury bill, there are certificate of deposits. We will discuss. These are different instruments of money market. The money market provide demand and supply of short-term funds. It provides funds to those persons who wants funds for a very small period of time. Money market provides necessary liquidity in the market. Next, we will discuss what is different participants in money market. We have already discussed generally money market is dominated by banks and financial institutions. Apart from them, there are many non-banking institutions which also play a vital role in money market. In order to provide liquidity to money market, a concept called primary dealers is also introduced. Money market is also operated by mutual funds. Those funds which play in money markets are known as MMF or money market mutual funds. What are the instruments which are traded in money market? Generally, in money market, the following instruments are traded. First instrument is call money or notice money. What is call money or notice money? Call money or notice money, in case of call money, the funds are traded for less than 1 year. If a bank wants 250 crores for 4 hours only, he will go for call money. Notice money, a particular notice, a weekly money, that is known as notice money. There are commercial bill market. What is commercial bill? Where commercial bills are bought and sold. Generally, commercial bills are credit instruments. In case of credit transactions, commercial bills are generated and these commercial bills are bought and sold in C-bill market or commercial bill market. There is another segment of money market that is known as T-bill market or treasury bill market. So T-bill market is a segment of money market. Then there is another form of money market, segment of money market, that is commercial paper market. Yes, CP market. What is commercial paper or CP market? in case of commercial paper or CP market, high rated corporates, if they want short term money, they issue commercial papers. Let's take an example. Reliance want 250 crores for 2 months. So it will issue commercial papers, and person will buy commercial papers, and with the help of these 250 crores can be generated by Reliance through money market. There is another segment of money market, that is CD market, that is certificate of deposit market. What is certificate of deposit market? These are time deposits which are negotiable in nature. These are fixed deposit which are negotiable in nature. Negotiable means transferable. So CDs are just like time deposits but have negotiability. The CDs are bought and sold in money market. RBI also enters into money market. RBI is a major player in money market. RBI is the regulator of money market. RBI enters into money market through repo market. What is repo? Repurchase option. It's a window through which RBI lends short-term money to commercial banks. You know, in the credit policy, RBI designed these repo, reverse repo rates. RBI decides. So with the help of this, RBI controls the interest rate in the market. Then RBI does its OMO, open market operation, in money market. RBI decides the CRR, SLR, repo transaction to control liquidity and manage interest rate. There are two objectives of RBI. One is control liquidity in the market and regulate interest rate in the market. And all these two objectives are achieved by RBI with the help of money market. So we have discussed different types of money market. Next we will discuss another concept that is known as capital market. We have known that money market is a market for short-term funds. But capital market is a market for long-term funds. money मार्केट शॉर्ट टर्म फंड्स के लिए, कैपिटल मार्केट लॉन्ग टर्म फंड्स के लिए. मनी मार्केट में जो इंस्ट्रूमेंट ट्रेडेड होते हैं उनका ड्यूरेशन लेस देन 1 ईयर होता है. कैपिटल मार्केट में जो इंस्ट्रूमेंट ट्रेडेड होते हैं उनका ड्यूरेशन मोर देन 1 ईयर होता है. So money market is a market for short term money and capital market is a market for long term money. In capital market, equity instruments or ownership securities and debt instruments or creditorship securities are bought and sold. So capital market provides long term finance to different borrowers. जिसको लॉन्ग टर्म के लिए पैसा चाहिए वो कैपिटल मार्केट में जाएगा, जिसको शॉर्ट टर्म के लिए पैसा चाहिए वो मनी मार्केट में जाएगा. These are money market is regulated by RBI, whereas capital market is regulated by SEBI, Securities Exchange Board of India. So these are the main difference between money market and capital market. Now next we'll discuss what are the functions of capital market. We have already discussed capital market helps to channelize long-term money from saver to seekers. Once long-term money is provided, it helps in creation of assets by the borrowers, and those assets are mostly productive assets, and those assets are mostly long-term assets. Money markets issues, a capital market issues equity instruments or debt instruments or quasi equity instruments to raise the money. So these are the functions of capital market. Now next, the capital market is of two types. One is known as primary market Another is known as secondary market. What is primary market? Now please see, suppose let's take an example. The Reliance wants to raise 20,000 crores from market. What Reliance will do? Reliance will divide this 20,000 crores into smaller and smaller part. Each part is known as a share. So share is a part of own capital of the company. Reliance will issue this share to the public and public will buy it, and this type of market is known as primary market. So primary market deals with new securities. What is new security? In primary market there are two parties. One is company, another is investor. There is no कंपनी से आप अगर शेयर खरीदते हैं, नया शेयर खरीदते हैं, नया सिक्योरिटी खरीदते हैं, नया बॉन्ड खरीदते हैं, कंपनी से खरीदते हैं, उसको बोलते हैं न्यू सिक्योरिटी मार्केट और प्राइमरी मार्केट। प्राइमरी मार्केट में आप सिक्योरिटी, जो आदमी सिक्योरिटी इश्यू किया है उससे पहली बार खरीदते हैं, उसको बोलते हैं न्यू इश्यू मार्केट। अगर एक कंपनी पहली बार लोगों से पैसा उठाता है उसको बोलते हैं आईपीओ मार्केट, इनिशियल पब्लिक ऑफरिंग मार्केट और आईपीओ। अगर सेकेंड बार, थर्ड बार, फोर्थ बार पैसा उठाता है, सेकेंड टाइम, फोर्थ, थर्ड टाइम, फोर्थ टाइम इट रेजेस मनी, दैट इज नोन एज एफपीओ मार्केट, फॉलो ऑन पब्लिक ऑफर मार्केट। सो न्यू इश्यू मार्केट में बी आईपीओ मार्केट or FPO market. In IPO, for the first time, company raise money from the public. In FPO, subsequent time, when company raise money in the market, it is known as FPO market. But whether it's IPO or it's FPO, new securities are bought and sold. The in IPO market, who participates? Companies participates. Company raise in money through new issue of new securities. Government participate. Government raise funds through issue of bonds. Public sector units also participates. So new issue market, new security market is known as primary market. Once you buy the security, if you want to sell it again, you have to go to secondary market. So secondary market is that segment of capital market which deals with already issued security. That means it deals with outstanding securities. Those securities which has already been issued, those are bought and sold in secondary market. Secondary market may be of two types. One is known as exchange traded market. Another is known as over the counter market. What is exchange traded market and what is over the counter market? What is exchange traded market? In case of exchange traded market, the existing securities which are already been issued in IPO market are bought and sold in a recognized exchange. If the securities are bought and sold in a recognized exchange, that is known as exchange traded secondary market. So in case of exchange traded secondary market, the price of outstanding securities or which were already issued securities are decided by an auction system. What is auction system? By matching buy order and sell order. People give options to buy the security at a price. People give options or auctions to sell the security at a price. And this buy order and sell orders are matched and the price is determined. And if this type of market exists for securities, those are known as exchange traded market. So there is a exchange, there is a organized trading of securities in case of exchange traded market. Once a market is exchange traded, it's a highly regulated market. And if it is regulated, then there is transparency in the market. Then the transactions undertaken under exchange traded market are guaranteed by the exchange. That means there is a less chance of default in case of exchange traded market, and prices are known to each other. It's a highly transparent market. Highly transparent secondary market is exchange traded market. But in exchange, all the securities cannot be bought and sold. Let's take an example. India has, let's take an example, 2 lakh companies, recognized companies, 2 लाख कंपनी, लेकिन मार्केट में सिर्फ 5-6 हजार कंपनी का शेयर ट्रेडिंग होता है. बाकी सारे कंपनी का शेयर का सेकेंडरी मार्केट के लिए एक्सचेंज ट्रेडेड मार्केट अवेलेबल नहीं है. क्यों अवेलेबल नहीं है? एक्सचेंज में ट्रेडिंग होने के लिए आपको एक्सचेंज में लिस्टेड होना पड़ेगा. लेट्स टेक एन एग्जांपल. एक्सचेंज, 2 बड़े बड़े एक्सचेंज है स्टॉक एक्सचेंज इन इंडिया. वन इज बीएससी एंड एनएससी. Another exchange is coming, India INX. In GIFT it is coming. Now, अगर BSE में आपका कंपनी का शेयर ट्रेडिंग होना है, you have to fulfill certain listing norms of the exchange. If you cannot fulfill those listing norms, your company's share cannot be bought and sold in that exchange. So only in NSE 2,500 plus companies are listed. In BSE 5,000 companies are listed. 5,000, 2,500, there are some common listing. Nearly 6,000 companies shares have a exchange traded secondary market. But we have told that more than 2 lakh companies are registered. So rest companies share have a secondary market, but not in exchange traded form. That is in OTC form. That is known as over the counter market or OTC market. In case of OTC market, the transactions are negotiated privately between parties. There is no middleman like exchange. The prices are not transparent. In order to create OTC market, there are primary dealers are created. What is primary dealers? PD or dealers, they provide a two-way quote. What is two-way quote? Two-way quote means they give the option to buy or sell a security at a price. They have a market making mechanism. लेट्स टेक एन एग्जांपल. आप अगर किसी ज्वेलर के पास जाएंगे, उसको पूछेंगे गोल्ड का रेट कितना है, वो बोलेगा आप गोल्ड खरीदेंगे या बेचेंगे. मैं आपसे गोल्ड 50,000 में खरीदूंगा और आपको गोल्ड 55,000 में बेचूंगा. ही गिव्स टू रेट्स. वन इज बाइंग रेट, अनदर इज सेलिंग रेट. बाइंग रेट इज नोन एज बिड रेट, सेलिंग रेट इज नोन एज एक्स रेट. तो प्राइमरी डीलर्स जनरली प्रोवाइड two-way quote, buying rate and selling rate. With the help of this, OTC market operates. So OTC market operates through primary dealers, and exchange traded market operates through a recognized exchange. There are many limitations of OTC market. First limitation is price is not publicly known. It is not transparent. It is not well regulated. There is chance of default risk in case of OTC market, but it provides liquidity to those securities which cannot be bought and sold in exchange, in an exchange. So this is secondary market. Next we will discuss different type of financial markets. One is equity market. I have already discussed what is equity market. Equity market, equity, in case of equity market, equity shares are bought and sold. What is equity shares? The entire capital of a company is divided into smaller and smaller part. Each such part is known as share. So share is a part of ownership security of a company. In case of equity market, different companies equity share are bought and sold. That means ownership security are bought and sold. That is known as equity market. The person who invest in the equity shares are known as shareholders, and the shareholders becomes the owners of the company, and the shareholders take all strategic decisions in the company, and in return of the investment, company pay them dividends. But mostly shareholders are interested in dividend as well as in increase in the value of their shares. That is known as capital gains. The shareholders are interested both in dividends as well as they are interested in equity, in appreciation of their share value. That is known as capital appreciation. So equity market over. Next market is debt market. What is debt? Debt market involves the trading of creditorship securities. Equity is ownership security and debt is creditorship security. If you invest in equity, you become the owner of the company. If you invest in debt, you become the creditor of the company. If you invest in equity, you will get dividend. If you invest in debt, you will get interest. These are the main point of difference between equity and debt. In debt market, different debt instruments or debt securities are bought and sold. Next, there are different segments of debt market. First segment of debt market is G-Sec market, a government securities market. In case of G-Sec market, government debts are bought and sold. Generally, governments, if want some debt from the public, it issues some bonds. Normally, for government, Reserve Bank of India issues the bond. So in G-Sec market, there is a primary market, there is a secondary market. If RBI issues the bond on behalf of the government for the first time, it is known as primary market. And once the bond is issued and available with different banks and financial institutions or different retail investors, they can exchange the bond between themselves before maturity in the secondary market. So G-Sec market is the vital part of Indian debt market. Most of the trading in Indian debt market is in government securities, government debts markets. Another debt market is segment of debt market is corporate debt market. Surprisingly, in India, corporate debt market is not so well developed. It is still in underdeveloped stage. We do not have a debt culture in India. Corporate debts do not have a major chunk of Indian debt market. Corporate debts market is a market where different corporate debt securities, creditorship securities are bought and sold. Debt issued by Adani, debt issued by Ambani, debt issued by Reliance, debt issued by different companies are bought and sold in corporate debt market. In India, corporate debt market is not well developed as corporate equity market is developed in India. Next one is debenture. What is debenture? Debenture is a part of total debt of the company. It's an acknowledgement of debt. If a company wants 3,000 crores debt, It can approach a financial institution. Or what it will do, it will divide the 3000 crores debt into smaller and smaller part. And each part is known as a debenture or a bond. So what is a debenture or a bond? Debenture or a bond is a part of loan capital of the company. The person who will purchase that debenture becomes the debenture holder of the company. They are the creditors of the company, and company pays interest to them and repay the debenture holders after the agreed period. There can be convertible debentures, there can be non-convertible debentures. Sometimes debenture holders are repaid by converting their debenture into shares of the company. That is known as convertible debenture. Next one is bonds market. What is bonds market? Debentures are also known as bonds. Bonds may be of three types: zero coupon bonds, convertible bonds, callable bonds, puttable bonds. What is zero coupon bonds? In case of zero coupon bonds, the interest rate is not paid, interest is not paid, but zero coupon bonds are issued at a heavy discount to its face value. Suppose the bond's value is 100, it will be issued at 65. It's a 10-year bond. That means you will pay 65 and you will get a bond of 100. And you will wait for 10 years and you will receive 100 rupees. So 35 is the interest for the entire 10 year. That type of bond is known as zero coupon bonds. Convertible bonds, where there is a chance, there is an option given to convert the bond into shares of the company at a fixed price. What is callable bond? Callable bonds is a bond which give the company a right to redeem the bond before its due date. And puttable bonds is a bond which gives the investor a right to take back money from the company before its due date. That is known as puttable bonds. So these are different segments of corporate bond market. Another market is derivative market. What is a derivative? Derivatives are financial instruments which do not have their independent value. They derive their value from the value of the underlying assets. So what can be the underlying assets? The underlying assets can be equity. The underlying assets can be a commodity. The underlying assets can be an index. So there is equity derivative, there is commodity derivative, there is index derivatives. In derivative market, there are two types of derivatives. One is simple or vanilla derivatives. Another is complex derivatives. Simple or vanilla derivatives are of four types: forwards, futures, options, and swaps. Out of which forward and swaps are OTC products. OTC means over the counter products. Those are not bought and sold in an exchange. Those are not standardized. Those are customized products. So forwards and swaps are customized products, whereas futures and options are standardized products. Therefore, the derivative markets are also known as F and O market, futures and options market, because futures and options contract are bought and sold in an exchange. Futures and options are exchange traded instruments. So derivative market has two components. One is OTC derivative market, another is exchange traded derivative market. OTC derivative products has a default risk, but exchange traded derivative products mitigate the default risk. This is derivative market. There is commodity market. What is commodity market? In case of commodity market, different type of commodities are bought and sold. What type of commodities? Bullions are bought and sold. Gold, silver, platinum. Ferrous metal is bought and sold. That is steel. There are non-ferrous metal like copper, zinc, nickel, lead, aluminum, tin. There is energy product like crude oil, natural gas, heating oil, gasoline, agricultural commodities like soya oil, people, palm oil, coffee, pepper, cashew, almond. These are bought and sold. Commodity market has two segments. One is spot market, another is derivative market. In case of commodity market, spot transactions take place where payment and delivery make simultaneously. And in case of derivative segment, commodity derivatives, what happens? The payment and delivery will be made on a future date, but its price is decided today. In India, important commodity markets where derivative products are bought and sold are MCX, Multi Commodity Exchange, NCDEX, National Commodity and Derivative Exchange, NMC. These are some of the important commodities market in India. Next market is Forex market, foreign exchange market. What is foreign exchange? Forex. In this market, different type of foreign currency are bought and sold. What is foreign currency? Indian currency, INR is our domestic currency, Indian rupees. Except INR, all other currency of the world are foreign currency. So, Forex market, foreign exchange market or currency market deals with trading of foreign currency. In Forex market, spot transactions take place, derivative transactions take place. In spot transaction, payment and delivery made simultaneously. In derivative transaction, payment and delivery will be made on a future date, but the price will be decided today. There are currency forwards, there are currency futures, there are currency options, there are currency swaps. These are currency derivative products. And currency is also bought and sold in spot market. Dollar is traded, yen is traded, euro is traded. These are forex market. So we have discussed forex market. Forex market has spot market as well as derivative market. And there are certain other markets. There are loan markets where loans are taken, term loans are bought and sold. There may be short-term loans, long-term loans, these are bought and sold. There are insurance markets where insurance products are bought and sold. What is insurance product? There can be life insurance product or non-life insurance or general insurance product. Life insurance product and general insurance products are bought and sold in insurance market. There is retirement and saving market. What is retirement and saving market? In a retirement saving market, different retirement products are bought and sold, like pension fund products, superannuation fund products, provident funds. Next, there is mutual funds. What is mutual fund market? Mutual fund is a collective investment mechanism with the help of some professional body. Mutual funds, in case of mutual fund, there are small investors pool their money and create a fund and give the money to a professional fund manager who manage the fund, and the return is generated between the persons who have given the money. That is known as mutual fund. There is saving and investment market. In case of saving and investment market, there are different retail financial savings, small financial savings are bought and sold, like cheat fund market, nidhi market, mutual benefits market. These are different type of financial market. Next, we will discuss different participants of financial market. Who are the participants in money market? Who are the participants in capital market? In money market, we have told that money market is predominantly dominated by banks. It's a interbank market. In money market, the participants are Reserve Bank of India, DFHI, mutual funds. Money market mutual funds play in money markets, banks, corporate investors, NBFC, state governments, provident funds, primary dealers which provide two-way quote, bid rate and ask rate, State Trading Corporation of India, public sector undertaking, NRIs, these are the major players or participants in money market. Next, we'll discuss who are the major players or participants in capital market. In capital market, participants are banks, non-bank financial institutions. With them, retail participation is important. Institutional investors and retail investors are the two important participants in capital market. Institutional investors are banks and non-banking financial institutions, hedge funds, mutual funds. These are institutional participants in case of capital market. And there is retail participation. Retail investors also participate in capital market. So these are the major participants in capital market. Next, we will discuss, we'll make a summary of our discussion today. So what we have discussed? We have discussed market is a place or a mechanism. Market, the traditional concept of market is a place, but market is a mechanism through which buyer and seller meet together to exchange goods, service, or financial product. So market may be, we have discussed product market, factor market, financial market. Financial market helps to channelize the funds from surplus units to deficit units, from net saver to net seekers. And there are two major segments of financial market. One is unorganized market, which is dominated by money lenders, and another is organized market, which is a better form of financial market. In organized market, there are capital market, money market, and other market. Capital market deals with long-term funds. Money market deals with short-term funds. And other market, there are commodity market, there are derivative market, there are other financial markets. Markets may be OTC market or markets may be exchange traded market. If the market is done, if the exchange is done through a recognized exchange, that is exchange traded market. If it is privately done, it is known as OTC market. Next, we have discussed certain keywords. What are the keywords of our discussion? First keyword is financial market. Financial market is a market for financial products, financial securities. It helps to channelize the funds from net saver to net seekers. Then money market. We have already discussed money market is a market for short-term funds. In money market, short period funds are bought and sold. The duration of the funds is generally 1 year to less than 1 year. 1 day to 1 year. Overnight to 1 year. Funds are bought and sold in money market. Next, we have discussed capital market. We have discussed capital market is a market for long-term funds. It has two major components. Capital market has a equity component and a debt component. So capital market is divided into equity market and debt market. Equity market deals with ownership security, whereas debt market deals with creditorship security. Whether the capital market is further classified into two parts. One is primary market, another is secondary market. We have already discussed primary market is the market for new securities. It is known as new issue market. And secondary market is the market for outstanding securities. What is outstanding securities? The securities which have already been issued. Those are bought and sold in secondary market. Secondary market may be created through an exchange or through dealers. Clear? So secondary market. It's secondary market over. Next one is investment companies. What is investment companies? These are mutual funds company. They collect funds from different peoples and they invest. Those are mutual funds company. The person who give the funds to these investment companies are issued certain units of the particular company. So that is known as mutual fund company, that is collective investment schemes. Next, we will discuss some important questions of today's class. First question is, what is a market? Discuss the evolution of financial market. Next question, what are different types of market? Next question is, what is the meaning and significance of monetary market? Next, what are the functions of capital market? Next question is, what is equity market? And discuss different reforms in equity market. Next one is, what is debt market? Explain the components of debt market. What is forex market? And what are the major currencies which are traded in forex market? With this, I conclude my lecture today. Thank you. Thank you for attending the class. Thank you.